but Robert says, do you have an opinion on doing calendar spreads on the week of earnings and close to just before earnings announcements to take advantage of the increased volatility? No, I don't. Okay, there's two approaches to this. I have investors who will look to do a calendar spread around earnings in the sense of what they're looking to do is take advantage of the volatility of the short option, the higher implied volatility of the option that they're selling, and then still have the long option after the earnings event comes out to still play and take advantage of the position. That's how I see it commonly done. Sorry, I don't have my pod selected, do I? I don't know. Latest split site updates. Oh, I do. Okay. There it is. It's all the way at the bottom. Upcoming earnings. Let's take a look here. Oh, Nike's next week. 6/26. Okay, after the market. All right. Now, I can't do it this way. Let me go. I'm sorry. That is a good one, but let me go further out. Let's go to 7/2. CPR's console. FedEx. We'll use FedEx. We're going to use FedEx as our example. All right. So what I typically see investors discuss, Robert, when they're looking to do a calendar spread around earnings, we saw that FedEx is coming up on July 2nd. So we're expecting volatility to start increasing. Now it already has increased. What an investor might do is they're going to buy the July 17th, let's say 125 call, and sell the June 26th, maybe the 139, maybe the 140. Let's keep it at 140, okay? Keep the numbers simple. All right? Reverse it. Okay. All right, so it's a 15-point spread in this case, and we're getting a debit of $13, so we're where we need to be, where our debit is less than our difference in strike prices for a profitable position of 27%. The idea being I'm trying to cash in on this premium on the 26th before the July 2nd earnings, and my long call is out in time to take advantage if there's a large rise. So I'm going to try to lower my cost basis by getting the implied volatility prior to the earnings. I might buy a cheap put for the July 2nd expiration in this case, in case the stock falls, to hedge against the long. What I don't think investors do is do sort of do it, and I think this is maybe your question, doing a calendar spreads on the week of earnings and close just before earnings to take advantage. Okay, so what you're saying is that if I was interested in this position, I might do a calendar by buying the June, oh shoot, I might buy that June 28th at the money position. Let's keep it closer, do the 130, and then sell the week of expiration, the week of earnings, my apologies, the 138, let's say. Okay, sell by. So it's a different structure. So here, I'm trying to force it through the earnings, and then you're saying close it because just before earnings announcement, because of the increased volatility. Well, it doesn't make sense to me. This structure doesn't make sense for that play. Why? Because yes, I'm gaining volatility potentially on this call that I bought, but this one is probably also gaining an implied volatility faster, and that's the one I have to buy to close. The ratio of implied volatility is going wrong. This isn't reacting as fast to an increase in implied volatility as this one, which is going to be most affected. The one that I've sold with that July 2nd expiration, its position is going to be most affected by the increase in implied volatility, the nearest term. Okay, the one nearest to the expiration. So I've sold this one, and to buy it back, the implied volatility is increasing faster than the option that's slightly further out in time. I wouldn't do typically that approach because I think it's putting the implied volatility gain that you're talking about against you. The short option is gaining an implied volatility faster. The one that's going to be most affected is increasing an implied volatility faster. Now, William does add a thought on that, which helps me out. So I had mentioned that I've seen people do the calendars straddling earnings, meaning that the short one expires before the earnings event and then the long one is after it. I think trying to play a volatility increase in this case with this calendar spread to me, I'm worried that it's going to hurt you, Robert, because the implied volatility of that option that's going to be most affected should be increasing much faster than the one that's further out in time. William helps me out here and says, I have a very good earnings strategy using diagonals and strangles that I would be happy to share with you offline. That sounds great, William. Why don't you feel free to send me an email over the weekend or sometime. Let me know what you're doing that, and I can relate that to Robert, or just talk about some of the things that you saw as well. And most of the investors I've seen, Robert, that try to use that advantage of volatility, by the way, leading up to earnings, they're buying a straddle or they're buying a strangle, a call and a put at different strike prices out of the money, but they're also buying it 4 to 5 weeks ahead of the earnings, because that's when the increase in volatility and implied volatility really starts. Yes, you see some of the last few days, but the true advantage of seeing an implied volatility is going out and getting those positions, the long options, 3 to 4 weeks prior, not 3 to 4 days. Okay. Ernie also tested this. He tried doing that volatility increase play around earnings. He didn't see much success with it. He had success with it with testing, but it was minimal. Okay, over the course of 2 or 3 years, I think it was a 10%, 12% profit, because a lot of times it just didn't pay, or you didn't see the volatility move that you expected going into earnings. It was much more gradual and not as fast, and then you lost the time value because you had to buy them 3 to 4 months out of time. I'm sorry, 3 to 4 weeks prior to it anyway to see the volatility increase, but you gave up the time value. And if you bought it too soon, you only bought it 4 or 5 days. That's the straddle, the strangle before earnings with the hope to close it before earnings. You didn't really see as much increase in implied volatility as you thought. It was already factored in, most of the volatility increase in the past couple of weeks. Sam goes back to comment on his idea, not his idea, but his plays, that when you do a 3-day spread, you need to cherry pick the stock with high relative value, has a strong upside move, and did you say low? And low volatility, okay? Plus the need to check the ATR return as well, so you can select the correct strike for success. So I'm sorry, the ATR. Check the ATR for looking at the best strike for success with those spread positions. Yeah, I can see that. You want lower volatility at pain up, makes perfect sense, because what do we know is going to happen in that short 3-day time period if you're doing a 3-day spread? Well, your volatility, your delta is going to 1 or 0, and your volatility is essentially going, your implied volatility is going to essentially 0 too. It's decaying rapid out as well. Okay. Frank, you had a previous comment. You said, can we assume it's March again? I started listening to playing the bear side of the market. It's a members-only webinar at Radioactive Trading for the Blueprint. And, okay, so you're saying, all right, any power options search suggestion besides just buying puts for when the expectation is the market is going down? Well, I could just talk strategy. We're not going to have the time to walk through search criteria. But yeah, if you're expecting the markets going down, what you'd want to do, of course, is protect or hedge the positions that you have open that are bullish, or maybe close some of the spread positions you have that are bullish. You consider bear call credit spreads. You can consider buying shares of UVXY, the volatility ETF. As Sam mentioned, that's what he likes to do because it doesn't have to fight the time value of buying VIX calls or things along those lines. If you think the market's going down and you want to buy puts, Ernie has created those 2 put searches. The Bollinger Bands is what we would look for if we were buying puts across the market, whether you're expecting a downturn or not, but that's where I would start, is just with that default search criteria there, the Bollinger Band screen. The initial value is probably not. I'd probably use the Bollinger Bands that Ernie used to create for finding positions that are in a downturn now, but also look like they have more of a pronounced downturn with that also. But what's another way to play the bear side of the market? You've got bear call credit spreads. You could do the bear put debit spreads we talked about earlier in the presentation, okay? And we can go through different levels of that as well. All right. Okay. Okay. All right. Octavio says, Michael, can you share the status of the market sentiment tool back on February 19th, 2020? Yours only goes back to June 2020. Oh, okay, yeah. Yeah, so this one won't either. So this is June. Okay, so we'll go back to the market sentiment, and I can see sentiment history. Okay, let me get that. All right, so now here's a trick that you can try to do, but it probably won't work. It should work on yours, Octavio. It's not going to work on mine. So I can go back, and it goes all the way back to May. You should have this view. It should take you back to May 19th for the spread. Now, I'll have to check on that, Octavio. So when I click on details, it takes me to that day, May 19th, and I'm going to click on view overall sentiment history, and it's going to go back to April 20th. Now, why it's doing this is because right now I'm on a free trial. I'm on the free trial webinar account, which gives me what? It gives me 3 months of historical data. So this is probably going to allow me to go back to March 20th. So what you do is when you pull up the date, you scroll back down to the furthest date, and you click on details, and it'll pull that up for March 20th, okay? Then I can click View Sentiment History. Oh, it does. Mine does. So it goes back to 220 as well, okay? So there you are, 220. It was a neutral at 3337, and then we had that decline. But I'll tell you this. We reviewed this a couple webinars ago. There it is. January is when the sell warnings, and just before that, I think there was a strong sell warning, a bearish sell that was triggered on this in January of 2020 before the February spurn started to happen. And when that big drop happened, it went to a light buy. So it was around January 20th. We're at 3320, and you can see that SPX started to fall 327, 326, 3225. So that sell warning triggered on 122 when it started to fall, started to come back up, and then of course here was the height, but the sell warnings had already been triggered near that high before the easing off started to happen slightly there as well. So it was prior, it wasn't on that date. Geez, sorry there, Octavio. It wasn't on that date. The sell warnings came prior to that. Let me see if I can go back further. Yep, there it is. That's what I wanted. 117, bearish sell. We're close to the top. The top ended up being what, 3,380, 3,380 for SPX, 338 for SPY. When it was starting to hit 332 or 3,329, that's when we hit the bearish sells to say that something was potentially imminent. Now, and we saw it. As we saw going forward, we saw the easing off of those positions as well also, okay? William says, no, I think I just showed that. The sell warnings came here, and let's go back. It's going to take me too long to go back that way, isn't it? Oh, no, it's not. See, I faked it. I faked it out a little. So it only is allowing me to select a date back to April 2020, but I can sort of fake it by doing this, okay? So I can go to details, and it's going to pull up the date for 320, view overall sentiments. There you go. You said 224? No, it was still in neutral because it had been easing off. It had been falling off of that high, and then when it really took the big dip, it went to the light buy and the very bullish buy, and it's just crazy madness, of course, all through March. But it was at this time, this last very bullish buy, I believe, when there were 0 bearish indicators, which did happen up here too. This is about the time, 315, 312, and 320, I know for a fact. 325 is when Ernie started buying the January leap calls on positions like Apple, Microsoft, IBM, and things of that nature to go forward. I hesitated and didn't start buying to April when I started doing those positions, okay? Oh, well, okay, I just could have answered that by mistake. Octavia said, so after a sell warning, wait to get back in when you get what signal? Well, I just sort of answered that. That's when Ernie started seeing these signals here, when the bearish started to go to 0 and the bullish were at 9, 10, and 8. This is around the time he started sort of looking out further in time to start buying those one call here, a couple calls there, to sort of buy cheap calls on quality stocks that he knew were going to recover at some point. Didn't have to happen the next 10 days. Didn't have to happen the next month. He was buying leap calls, and I waited till April to start jumping back into that strategy. I was trading other strategies during March, managing some calendar spreads as well, still doing some of the married put positions, doing some adjustments on those, and some standard collars and bearish collars as well. Not short collars, but bearish collars. You're holding UVXY at 30, Sam. Maybe on Monday I might sell it if it goes up. UVXY is at, he says, 39 after market? Really? Okay. All right, so you got the 30 price there, moved up to 39. All right, and there's Octavio's comments on the market sentiment tool. And Sam comments back, says, another idea for the 10K investment is you could use SPXL for $3,000, and when it starts to go sideways, buy SPX for $3,000 and lock your profits in XPA. SL may do a paper trade in this, and as Jeremy is referring to, so he's talking about, what Sam's talking about there is ETFs, just buying shares of ETFs, the inverse the different SPXs that are available. I can spell today. XPXL quotes. Okay, so this is the bull 3 times S&P, and then the SPS would be the 3 times short. All right. I apologize. This is... Okay, William, sorry. This one's William. If one has $100,000 in a 401k that they're not able to trade, how could one hedge it with using a married put? I'd buy puts in a different account on SPY or one of the other broad-based ETFs, okay? Beta weight the 401k to SPI and then buy the appropriate number of SPY long puts or some other method. Yeah, so I would look to do that. There are other methods, William. That comes in that blog and the video that we had called Stock or Portfolio Insurance in that case. And so, yeah, the 3 times leverage ETF. So the stock or portfolio insurance, I don't think... I'll send you the link to it, William, so you can take a look at it. The stock or portfolio insurance part 2. We touched upon this a couple weeks ago also. And what that was looking at, William, was we used the long option finder, and when I'm thinking about buying puts on SPY, let's say I have an exposure in the market of $10,000. I know we're talking about, you're talking about $100,000. Okay, let's keep $100,000. And let's say you're worried about a 20% decrease in the broad market, another March perhaps, or a more extreme March, as was just mentioned. So you're beta weighted against SPY, and you know that if the market falls 20%, you're going to lose $20,000. Now you want to hedge against that, so you want to buy a married put, but here's the question, and this is what you want to ask yourself. Do you want to hedge the full 20,000? Of course, we all do, but does it make more sense financially to just hedge half of that? So if the market falls 20, you only lose 10. In other words, don't buy the puts you had mentioned, that the full amount of puts you would need to hedge the full loss, hedge half of it. 50% of the loss you'd expect in the worst case scenario. And the long option finder sort of helps us. So if we're at SPY, and let's say I expect it to drop down to 262, for example, and I'm going to use $1,000 as an example. Okay, I'm just using this in the long option finder. Oh, I didn't put a date, so it's going to assume 30 days for me, I believe. And it's got a lot of calculations, so it takes a long time when you do SPY with the long option finder. I should have remembered that. Okay. Long story short, just like we saw with the long calls, it's going to show me which put would give me my best bang for the buck. So this put would be at 537. And it's I could buy one contract worth roughly my $1,000. Yeah, one contract in this case. So what this is showing me is it's currently at 308. So I'm assuming almost a 40-point. I'm assuming a 40-point decline, which is a little bit more than 10. It's about a 12% decline. Okay, so if this dropped 46 points, in this case, then you could assume that, you know, this percentage here, 46 points of 30. Oh wait, yeah, 46 points. I'm sorry, of 308. Let's just assume it's a 13% loss. Okay, so you knew you'd be down $13,000. Now, what has this shown me right here? This shows me that I'd have a gain of roughly $2,100 per contract. A little bit less, but I paid $537. It would be priced at 26 theoretically, so I would have had $2,100. So you're going to experience a $13,000 decline on your $100,000 401k if the market fell this 13%. So how many contracts would I need to buy to hedge half of that? Well, $2,100. We need to hedge 13,000, so I'd probably only need to buy 4 contracts. Not even, really? Now that'd be more. We need 3 contracts, 3.5. So let's call it 4. So we buy 4 contracts for 2,000 and some odd change. They go up to 26. We get 8,200 back, which hedges the loss. And it's only 4 contracts. It's only $2,000. If the decline was this extreme over the next 30 days. That's how I use this tool, William, to analyze it. So you had a $100,000 account, and let's say we expect a 13% decline, and this is weighted almost even with SPY/SPX. So if we think about a 13% decline, well, we'd lose $13,000. This is a profit here of $2,100. So if I wanted to hedge half of that, 6,000, 7,000 of it, looks like I'm buying 3 to 4 contracts and I'm set. Not a lot of money, $2,000, right, to hedge against that. And so that's how I use the long option finder, and I'll send you that link to that blog, Stock or Portfolio Insurance Part 1 and Stock or Portfolio Insurance Part 2. Oh yeah, Yvonne, I did answer your question, but not with a direct example. I'll look for a quick video for you too about how one can handle the married put position. You got a couple choices when it falls. You had mentioned the, for example, you buy stock 100 shares at 100, you buy the put, you've got a 5% risk, and the stock, let's say, tanks to 80. What do? Again, that comes down to the SIGA model we sort of discussed that's described in the blueprint for each of the income methods. We could choose to just exit the position. I could readjust the position with income method number 9. I could combine income method number 9 with another income method, or use income method number 12 if I thought the stock was going to continue to move down in price. And the decision would be made, of course, based on the SIGA model that you have for the position, your personal goals. What does the SIGA model stand for again? Well, the current conditions in the market, your expectation of the stock going forward now that the event has happened, your personal goals for the trade, and that determines your action. And the blueprint, the SIGA model, is described for all 12 income methods when you would choose to do them, and when you'd look to do one over the other based on your expectations. And if none of them match and you don't think the stock's going to recover, my stock fell 20%, I can get out with a 3.5%, 4% loss. Let me just move on to a better trade. Sometimes that's the best play, no questions asked. Other times, it benefits really well to manage the position using the different income methods in the bearish once the stock has declined in that case. Oh, all right. Well, ladies and gentlemen, I just wanted to remind you that today's material are my thoughts and your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. I'm not opening any positions on SAVE, JP Morgan, NPXI, or some of the other ones we talked about as well. Remember, options do involve risk. We discussed that today and how to avoid some of the risks, and it may not be suitable for all investors. If you'd like some of the tools you saw today, we actually didn't get a good look at the search, although we went in briefly to look at the bull puts with the different probability with the higher returns to answer that question that came in earlier about the setting up a spread that has more of a 3-to-1 risk-reward ratio or 2-to-1 as opposed to a 7-to-1 or 8-to-1 risk-reward ratio. But if you like the other tools, remember you can take a 14-day free trial at any time. Just go to PowerOp.com, put in your name and email address. You'll have full access to the site for 14 days. After that, the subscription started only $45 per month, but that's for the end-of-day data service. 20-minute delayed service is $65 per month. They have access to mostly all of the tools, but just not the real-time data. And then, of course, you can also add the historical package for only $35 more. So the delayed plus the historical is only $100 per month. It allows you to do years of back testing as well. Okay. Okay, so other free information, well, of course, all of our webinars are typically posted on PowerOption under the free webinars tab. You can just go to powerop.com/webinars.asp. Remember, you can also go to YouTube at any time. That's where most of our segmented archives are posted as I split these up over the weekend. You can also check us out on the blog as well. Jazz, you said, I'm new. How do I get this info? I've signed up for the 14-day free trial. Okay, so I don't know which info you mean. We record every webinar, and I usually post it sporadically throughout the week. What I'm going to do is take this hour and 42-minute presentation, cut the segments together, and put some segments together where we jumped conversation from one to another. So there's 3 to 4, maybe 5 different segments of the consistent conversation rather than little tidbits here in a long presentation. If you're referring to the stuff I was talking about, what I was talking about in regards to the married put, radioactive trading, the blueprint idea, limited risk trading, the blueprint is a product. It's an educational course that we offer to learn how to trade the proper married put approach with the 12 different income methods used against the married put limited risk structure. You can read more about that here. If you just go to the married put tab, you can start off with the 4-part article that Ernie wrote covered called Challenge Limited Risk Solution, also the free white paper, the sketch. You can access that as well. It sort of introduces the married put ideas and talks about income method number 1, just selling the call. But the blueprint is the full course that discusses the full techniques and all 12 income methods, and that's a product. It's not a product we ship anymore, meaning it's not a physical copy anymore. So you get an immediate electronic access when you pick up the blueprint. Okay, so Jess, oh, you're welcome. Good. I'm glad that's what I was clear on what you were asking there as well. Also, all right. So let's see here. Let me go back. Just talked about that, and all right. So if you think of any other questions at any time, remember, send me an email. You can send it to support@poweropt.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And on your trial or as a subscriber, you can schedule a coaching session at any time. It's effectively a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Well, thank you all for your questions. Thank you all for your help, too. William and Sam and Bill, you know, the comments that you had on the other strategies and everyone helping out the conversation there with the $10,000 we were talking about for Jeremy, and the diversification is a very great discussion. And William, thank you. You said have a great Father's Day. Yes, all of you out there, have a great Father's Day weekend. Have a happy Father's Day weekend. Thank you all for joining me. I'll start to get these posted webinars out some point this weekend, and we'll send everyone an email as they start to get posted. I assume the first one will probably be Sunday morning there when you'll see the first one, if not late Saturday afternoon. All right. Then Sam, thank you too. You have a great weekend. Guys, take care, everyone. Take care. Ben, hey, it's good to see you too. You take care also. David, thank you for your questions, and I'm glad the conversation helps you out there, David, in relation to your question you sent in via email. So thank you all. Everyone have a fantastic weekend. We'll see you soon. Good night.